Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights, and actionable advice to help you master the art and science of diversified, systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
G'day, and welcome to episode 11 of Turtle Talk. I'm Rich, coming to you from Brisbane, and today, as always, I'm joined by my fantastic co-hosts from Sydney. We've got Adam Havryliv. Adam, great to have you back, mate. How was the sailing last month? And give us a quick recap of your ambitions to be in the next Sydney to Hobart.
Well, thanks for that, Rich. We had a practice sail, and it was Gold Coast to Coffs Harbour. It's about 200 nautical miles, and we did that in about 24 hours. And there's only two of us on the boat, so we're sailing two up, and obviously challenging with sleep and navigation and close quarters on a small boat. But we had a very, very good weather window and completed it in 24 hours just before a southerly change came through. Now, Sydney to Hobart, I'm still not sure, but maybe a few more practice laps before we commit.
Right, with just two of you, it's a bit of a challenge, the Sydney to Hobart.
It sure is, mate. It's a very, very big commitment, especially with the southerly fronts that come through periodically, bashing those boats. So not a light endeavour to be undertaken.
Anyway, Jerry from Tampa, Florida. How are things your side? What's happening over there, Jerry?
Not a whole lot. I just got back from skiing out west, Montana and Colorado. Not a lot of snow. But there was a snowstorm the day we left Colorado, and we got a little bit of that in Montana when we went there. So we had a pretty fun time out there. But Florida's a little cool, but it's going to warm up this weekend.
Yeah. This is unusual weather for you, isn't it, JP?
Not so much. I mean, there's crazy weather in the Northeast with all the snow, record snow and blizzards. But Florida's pretty normal.
Today we've got a very special guest lined up. Joining us all the way from London is Sanjeev Lakhanpal from Horizon3 Investment Management. I and all of us have been following Sanj and Horizon3 for a long time now, and I'm a big admirer of his work. So Sanj, welcome to Turtle Talk.
Thank you, Rich, and hi, Jerry and Adam. Thank you for having me. I'm very excited to be getting into things with you.
Perfect. So, Sanj, any news from old Blimey?
Domestically kind of thing? Not really, the government and the monarchy might get taken down by the big scandal. So just a normal week, really,
Yeah, I noticed that it's all, the heat is all in the UK at the moment. What's happening with the US, Jerry?
Oh, well, the U.S. is still riding high on our gold medal in men's hockey and women's hockey and beating the Canadians and enjoying a lot of Canadian tears. They're really into that. So we're just on sky high right now, and politics aside.
Oh, nice, mate. Well, Sanj, we're thrilled to have you on the show today, and we've got a lot to cover. So I'll give you a rundown of what's in store for today's episode. So first, Adam's going to take us through the battle of the trend indexes, and this is a look at how the trend-following indexes performed in January 2026. Then we'll dive into what's moved the needle, so some live market action and charts from both Jerry and Adam. After that, Sanj, we've got our spotlight segment, and this is going to be an extended conversation with you. We're going to explore your journey from AHL to Horizon 3, and for a breath of fresh air, we're also going to get into your new FX swap arbitrage program, if that's okay with you, which is genuinely fascinating. We've also got, following the spotlight segment with you, Sanj, we've got the Shell Mail this month and a couple of cracking questions from a good mutual friend of Jerry, Adam and myself. His name's Lee. He's got some very good questions. And I believe, Adam, you had a good lunch with Lee just the other day. He came to Sydney.
Yes, we went to the new fish markets in Sydney at Piermont, and it was just a lovely afternoon talking trend following.
I had the pleasure of having lunch with Lee. He came up to Brisbane, and he was referred by Jerry, of course. So, Jerry, you know Lee?
I've talked to him on the Twitter and emails, but I don't think we've met in person.
All right.
If we have, you really got me into an embarrassing situation, Richard. And, I'm an old man, so I probably don't remember meeting everybody.
No, fair enough. All right. So, and finally, after Shell Mail, we're going to be wrapping up with some closing reflections and a quick word about my new book, The Fractals of Finance. So, without further ado, Adam, take it away with Battle of the Trends.
Okay, Battle of the Trend following indexes or indices on AussieTurtles.com website, and what a great month! Everybody posting, around about the plus 5% mark. So a lot of happy trend following investors in January. I think, Rich, there you made a note on the low dispersion between those indices, and yes, everybody's hovering between 4.5%, 5%, that sort of thing. So a great result for all the trend following indexes. And we've got our own classic trend index, which is making new equity highs, really taking off there. And we are sure enjoying that V-bottomed recovery from the April drawdown of last year. And then I'm looking at some other indices which look like they're making fresh all-time highs, in particular the IASG trend following index, which is also posting some very interesting returns. And that's a great website if anyone's looking for managers to review. Have a pop on there and have a look at the IASG website. What else can I say? The low dispersion, it seems like, as mentioned, January was a very good month. We're going to go into exactly why, but I suspect it's metals, probably the primary driver. Rich, I'll hand it back to you.
Yeah, so definitely the month was strong for all of the indexes, which is great for the trend followers out there. Jerry and Sanj, were you happy with January?
Yeah, it was okay. Yeah. It was okay. We didn't shoot the lights out or anything, but we were fine.
Jerry, you posted a pretty good return for January, I noticed.
Yeah, I mean, we did pretty well in January, and it's just due to the trends in metals and some of the commodities, and still waiting for something to happen material in the dollar. Everyone talks about the dollar, but weakness, but it's not moving very much. It moved last April. It made a big move up, and it's maybe threatened those highs, threatened those lows a few times. But I got confused because I'm talking about the individual currencies, which is the way I kind of look at it. But except for the yen, the yen maintains its downtrend, but all the other currencies are sort of strong. But we haven't seen this trend take off like we have in gold and silver and the metals, in particular, base metals as well. But I'm sure we had a bunch of our stocks. We trade 200 stocks in the portfolio. So some of those stocks have really done well. Some of those stocks look like silver and gold. And that's kind of what you need if you're going to trade a lot of different markets, because we're not getting, like everyone else, unlike everyone else, we're not getting these outside returns due to the metals, because we don't get an outside return from any market because the portfolio contains 400. So we're getting a lot of good trends in some of the individual equities.
One thing I can say, this probably been one of the strongest months we've seen for quite a while in trend following across the board. And I noticed February, it's certainly seeming to follow through into February as well. Is that what everyone's experiencing here a bit?
Yes, I think the equity indices, from our perspective, are doing well in February, and the metals. I'm not sure whether everybody has still got loose pants, or I mean January was crazy in terms of that correction on the last day of the month. So I suspect the trend followers would have given back a little bit of performance on that last day, and maybe some people have exited those long metal positions based on the volatility. I'm not sure how loose everybody's pants are.
Despite that retracement in the metals, still everyone posted a fairly good result for January. So a lot of these trends, they've been going for quite a period of time. So yes, you lost a bit of unrealised equity in January if you had the loose pants, but you still posted a good month. I noticed VAMI did a very good month for January. So another important thing I think I can say is that if you look at the classic trend index, it's now surpassed a 140% cumulative rise since January 2020, since this report was active. So it's also offering a CAGR of 15.5%. So, and it's continuing to lead the pack of the other indexes. So when you look at the VAMI chart, you see a clear dispersion between classic trend and the balance of trend following indexes. And I'm attributing that specifically to the additional convexity offered by classic trend. So it happens to be, this 2020 to where we are now, a very favourable regime for those particular classic models. It's not to say that that's always been the case, but certainly the regime is favourable for classic trend. And you're seeing this with this divergence, this pulling away from the other trend following indexes.
Long may it continue.
Exactly.
I know we've got the charts coming up, but that volatility, that metals volatility in January, it's historic. The size of those corrections, and maybe we can move on and have a look at some of those charts, Rich.
Good point. So we're going to now move on to our next segment, which is what's moved the needle. This is where we look at live market action and some charts that have caught our attention this month. So, Jerry, we'll start with you. You've brought some charts along for today. Can you talk us through what you're seeing?
Yes. Well, I've been listening to some of my favorite podcasts, and this subject came up about some of the metals and the sell-offs, and specifically about the last day of the month, from CTAs who do sell into these trends based upon increased vol. So maybe they do have some of the metals. I guess you can't go to zero, but they're probably gotten out of a lot of their gold and silver, at least, and platinum, palladium. I brought those charts along too. And tin, I thought tin was a good example as well, because the points that were being made in these other podcasts were that this is somehow material. We're looking at one trade. We've done these 40, 50-year back tests, and we are going to create these systems based upon our back testing and looking at lots and lots of data and focusing on one day of the month or one trade that, technically is not even over. I guess maybe if you want to predict that the trade is over and that you're happy to have liquidated 80 or 90% of your gold and silver, but I'm not willing to make that prediction. And I think you can't really, I don't think that based upon how we devise our systems, that we want to say that even if the trade is over and the people with the looser pants and who don't scale out based upon vol or correlation, that they end up not making as much money as others, then so what? I mean, we've got lots of trades. Even a superior system like classic trend following is not going to win on every single trade. So it's ridiculous to make points about this trade or this month when we're looking at systems and strategies that have 40, 50 years worth of data and deciding that this is how we're going to trade based upon that data, not what happens in January, February, or 2026, or one particular trade. So you can see in these charts what happened is these, as Adam was saying, these charts, the metals, they had a big run up. I have placed the volatility, the ATR at the bottom, a 20-day ATR at the bottom. You can see it skyrocketed as well. And I have heard other traders talk about using volatility almost as they're thinking it's almost a superior tool to determine when you're going to exit a trade versus the trend itself, which I find to be a little disconcerting and incorrect. I do understand if you're just itching to take a profit and you want to call it risk management, whatever, these trades are incredible profits. They're not going to turn into a loss. I know people want to come up with lots of excuses to liquidate and take some of these profits off the table. You're just really tricking the Sharpe ratio because if you get out at the high after a big run up or selling every day as these markets go crazy and the volatility increases and it's making new highs, then you're just fooling the Sharpe ratio because on that piece of the trade you had an infinite Sharpe ratio. There was no drawdown, so it's really just a game, I think, that's played to satisfy clients and probably help raise assets. But also, I genuinely believe that there's a lot of trend followers out there who really cannot imagine trading a trend following strategy without selling into these type of rallies because they just couldn't bear to have to suffer through these drawdowns, even though I hear all the time on these same podcasts that quotes from different studies and from MAN or AQR or their own studies that look back periods of hundreds of days, 150, 200 days is where the CTA community basically is now. And most of them, especially the ones with billions of dollars under management, have to have a slower systematic approach, and the approach is better than the shorter term strategies. So that's what I kind of stick with those longer term strategies and letting the profits run and not taking small profits.
Yeah, to your point, Jerry, if you if you are going to sell and override it, which I would not advocate at all, but who's to say that 75 to 80 zone on the way up wasn't the place to do it? And then if you did it there, how would you be feeling when it got to 100? And then ultimately it tops up somewhere at 115. To be fair, I think that market did things in the last 3 months that nobody really expected or could have forecast. But fading it on the way up, I don't think is our approach, and just trailing those stop losses and trying to get the most out of this mega trend is the way to play it.
Yeah, and as Richard has mentioned many times in his books and on his podcast, in order to maximize your CAGR, you need to hang in there with these trends and not be so eager to get out and sort of play or to a Sharpe ratio, trying to maximize the Sharpe ratio, especially in situations like this. You really need to stay in there. And if they go back to, how are you going to feel if it goes back to new highs and keeps going and gold goes to 10,000? But it's not always going to do that. I would be out of the trade now and would have scaled back based upon the trend if the back test said, you should, when you see a big sell-off like this, you should get out. But that's not what we see in the data. And that's what we have to go by, the long-term data, the back test, and not try to make points about this trade, that trade. One trade doesn't really matter. It's all the trades. It's the thousands of trades we've done in the past and the thousands we're going to do in the future.
Sanj, thoughts?
There's two schools of thought, right? You got the stop-based approach, and you've got the vol-weighted approach, and whether you go one or the other, it just changes the profile of your returns. And in some cases, vol weighting doesn't work out that great because you're out of a trend or whatever that really goes a lot further. But in other cases, like with Jerry's last chart in the cocoa, where you would have done well to have harvested profits from that trend, given the collapse. Do you know what I mean? And who knows where you'd eventually get short of that trend if you're going to go short as well, kind of thing. Do you know what I mean? So I think it's it depends on your style and your approach as to which way you prefer doing it. But a lot of research has shown that using vol weighting does give you a certain gains over time in your risk adjusted return, because obviously it lowers the vol of your program in a way that allows you to employ a little bit more leverage, but it's just doing that kind of on a portfolio basis as opposed to an individual market move basis. I'm gonna probably get into it a little bit later on as to why it may not matter so much as to, in terms of my views, as to whether you use a stock-based approach or a vol-weighted approach. I don't know what you guys do with your trading stops, but those moves in silver and gold were brutal. Would you not have been stopped out of those trades? Do you know what I mean? So then essentially, if you are stopped out of those positions, then obviously at some point you're going to signal or be stopped back in, and so that kind of changes the frequency of your trading, doesn't it? At the end of the day, once you're being triggered on stops and things like that, there is a certain frequency of trading based around your stops based methodology, surely.
Well, yeah, like I said, none of this. I think it's a kind of an ironic situation. These large CTAs and managed futures CTAs who use the dynamic position sizing and reducing positions based upon volatility and correlation, and probably in this situation, correlation was pretty dominant. Not sure about, volatility was really driving this thing, is that so they're, in this particular situation, with this dramatic increase in volatility, my understanding is they would be dramatically reducing the position based upon the increase of the volatility, and at the same time, with whatever position they have left, they would have very loose pants with it, because like I said earlier, all these studies and papers that have been written and the things you hear on podcasts and stuff that talks about very long look backs, 12-month looks backs, 10-month looks back. So we're not even close to exiting gold and silver. That's the strategy that I use. That's the strategy that a lot of the CTAs use. I'm not saying that maybe they have shorter term systems as well, but on these same podcasts, they're frequently talking about what's performed the best over the past year or whatever, and what look back periods perform the best over all the years. And with some exceptions, it's usually in this, hundreds of days, 10 to 12 month look back periods. So I'm sure that's what they're using. But the problem is they got out of 90% of the position. So with this inconsequential 10%, they're waiting to the 12-month low. So I'm giggling because it's kind of silly, right? And but I guess my whole point of it was I don't really understand making a claim that, see, it's working better now because we got out better and higher because we kept selling the highs and you guys suffered this big drawdown. And my point is, wait a second, dude, it's one trade. And it's not even over yet. We don't know what's going to occur. It could be a great trade and gold could go to 10,000, or we could actually lose money on the trade, or it could go back to break even or something. And on that particular trade, we didn't do as well. But it doesn't it doesn't alter the fact at all that if you look at a 40 or 50 year back test, having a 10-month, 12-month look-back period is superior to almost anything that's shorter term.
Yeah, I wouldn't mind adding a point here as well, is that the particular objectives that Classic Trend is working towards it's a recognition that volatility isn't bad, and it's a recognition that the thing that actually creates the CAGR for our particular objectives are the outliers. And what we're relying on is this ability to harvest the opportunities of these extreme positive skew moves that more than compensate for the volatility drag associated with the volatility profile that we've got. So this is different to many other trend following CTAs whose objective is to smooth the returns to make it a more appeasing ride for the investors. But I would be arguing that the CAGR objective is being compromised through that alternative approach. It's definitely a smoother ride. It's definitely more acceptable for investors, and the issues of timing, when to enter, all of these things is resolved through this smoother approach. But if your objective is CAGR optimization, I'm thinking it's the fat tails that is dominating the success of Classic Trend, and I don't think that trend followers across the industry are really opportunistically harvesting the fat tail properties. They're trend followers, but they're not going for the extreme trends. This is where I think our process, our objectives diverge, and this is where I think we've got to keep doing what we do, specifically because our entire edge is being dictated by these massive tail events that we can't predict, and the data sets that we use show that these massive fat-tailed events occur so frequently, totally against what the Gaussian proposal suggests.
You know, it really is. I think it really does come down to this. If your goal is sharp, yes, I can see it makes perfect sense, because my goal, of course, it's sharp. It's sharp as everyone's. Well, not so fast. Not Classic Trend. It's not sharp. And these were not losses. This is not a stop loss. The stop loss is losing a few ATRs when you put the trade on and it goes against your entry point and you're out. That's the stop loss. These are trailing stops. And this trade is probably not going to turn into a loss. It'd be unprecedented almost if it turned into a loss. So there is no loss to worry about here. But there are issues. If you're focused on sharp and that's what your goal is, then yeah, it makes sense, but not for us. And even in Rob had a paper, and he went through this process again and declared victory for the DPS crowd. And as a throwaway line, he had a throwaway line, which was the whole issue, which is, I make less money by doing the DPS, but I just leverage up my portfolio. That's the whole problem. You're taking bigger losses. So we're saying, look, yes, Jerry looks really crazy with this big drawdown, and sharp is really low, but Jerry's saying it's with the profitable trades. And what no one can really see is all these bigger losing trades if you use DPS in a systematic approach that has 60% losers. So where does this risk go? Does it evaporate? All of a sudden, we've uncovered the one area of finance where reducing risk is a free lunch. It doesn't go anywhere. No, it goes to higher losses, bigger losses. You have to leverage up and take bigger losses because you're cutting the profit short. And this is something we figured out 30 years ago. So it's not a throwaway line. It's material. What do you want to do? Pay attention to sharp and improve your sharp at the expense of bigger losses, bigger capital losses, real money losses when you're losing money, and not playing with the market's money when you're making money with these big, huge trends, and letting the profits run.
All right, look, we've got to move on in the interest of time. So, Adam, you've brought a few charts in.
Oh, yeah. a few charts. I know Jerry's done the metals, which I think where all the big action was in January.
Yeah, he stole your thunder. He did it. He always does this.
Well, no, we've got to. He gets to go first, and tin is a good one. That's a nice one to include. Now, what I've got in here is some more, steady trends, predictable trends, quote unquote, predictable trends. So the Toronto Stock Exchange just seems to be going.
An equity index to annoy Jerry.
That's we're doing really well on that one at the moment. It seems to be performing very nicely, and then I'm looking here at cocoa, which was very topical last year and the year before, but it's giving back to the trend following community again, because now it's in a massive bear trend. And it's just so, like, if you're trying to do this from the fundamentals or some sort of, we're moving to this new equilibrium and it's up at about 8,000 to 10,000, and this is going to define, cocoa prices for the next decade. And then, boom, we're in this bear trend, from 8,000. And now we're back to 3,000. It's like that whole squeeze never happened. And who knows where it stabilizes here, but I've given up predicting. Especially in these commodities. And then here, Bitcoin, which has obviously been huge on the upside, and but now sub 80,000, 78,000. I think there was some entry levels there short potentially for these medium to long term systems, and that went down very quickly. From that 78,000 all the way down to the low 60,000s, and then stabilizing here, but it's looking a little bit dicey for the longs. The bears are firmly in control at the moment, and that's what I'm looking at.
Yeah, well, I think the cocoa there was a kind of, after the massive rally, there was a lot of liquidation of those longs, but now it's more reflecting the improved weather outlook in sort of West Africa and the increase in supplies. And I think the actual high prices generated a lack of demand as well. So that's why the supply and inventories in warehouses has increased, and it's kind of reflecting that I think it's reflecting its own fundamentals at the moment, because I was a little bit surprised by the severity of this downtrend in cocoa in particular, because we would have thought with the dollar dropping 10% last year, something like cocoa and other softs markets would be going up, but no, it's not. It's responding to its own fundamentals more than sort of the wider financial aspects of things. Bitcoin, for me, it's just a greater fool market at the end of the day. It's whatever people are willing to find another fool to sell to, and I think it's dropped from significant levels. I think some institutions have probably been getting out of it, but it's dominated. It's kind of dominated by what's going on with MicroStrategy, right? The guy keeps borrowing billions and billions to buy the price, and now his average holding price is something like, I think it could well be like above 70,000. So he's now actually underwater. So I think it's a dangerous situation, because the sharks smell the blood in the water, right? When someone's so skewed like that, and they're saying that they've got capital adequacy as long as the price doesn't fall below 8,000. But I think that they could collapse, and other treasury firms who are not even as in the same position as them, because they don't have other businesses, they only have the crypto treasury. So the copycat firms in Ethereum and XRP or whatever I can see a scenario where they all get into trouble and we could see a massive decline in Bitcoin.
I probably don't agree with any of that at all. So that's fun. I love the Bitcoin. I love the cryptocurrencies. I'm selfishly believe that because I want this fifth sector. I want currencies, commodities, stocks, bonds, and crypto. I want more diversification. I love that these ETFs are coming out in all these cryptocurrencies, Solana, XRP, and there's new ETFs and new futures coming out all the time. I hope they don't all crash. I want them to survive. I think they're wonderful because I love this diversification. And why not? Why? I don't care if it goes to zero. Gold has been in big downtrends before. Am I going to get out there and say, well, I'm glad that's over with. Gold is no longer blah, blah, blah. Oh, wait a second. 2024, 25, 26, it is back to being what it was. So who knows what's going to happen in these markets? We don't really know. But I love these markets, and I hope they survive and they do really well.
But Jerry, you'd be happy to trade them from the short side too, right?
Well, I was going to say that in this particular situation, I'm giving away too much of my secrets here, but in this particular situation, all of Cocoa and Bitcoin are prime examples of if you go short at the breakout, the 10-month low or whatever, if it goes to zero, you're not going to make any money. If you're using ATR, which we're all using ATR, right? Or something like that. So why you could talk about a big down move in Cocoa or Bitcoin, but you're not going to make any money. You have a tiny position on. And ironically, this is where the evil of dynamic position sizing is going to help. And I'm like, oh, okay, well, because if you're like the classic guys and you're going to put that position on at the 10-month low and go short and have that fixed position and never change it, you're not going to make any money. But if you're using DPS in this particular short situation, if the vol ever got lower, then you could sort of start adding to the position versus taking it away because the vol, and then you could start building up a meaningful position, which I don't do and I won't do because I do the former, which is I put it on at the 10-month low.
Oh, thank goodness, Jerry. I thought for a moment you were going DPS on us.
No. I'm just saying, look, DPS is overall, I don't like it, but it's every bad idea has a couple of good trades or has some good characteristics or features to it. And this would be a good feature. And maybe this is why I'm always looking at these trades that initially when they break down and it's a short, the volatility is so high that if the market goes to zero, no one's going to make any money. And yet they're talked a lot about by managed futures CTAs. And maybe this is why, because they're adding to those positions as the vol goes lower. And it's actually at some point in time it can become a meaningful trade. Yeah. But right now, Bitcoin could go to zero and I wouldn't make any money.
All right, gents, got to move on. So now we're going to move over to our Spotlight segment. So, Sanj, for those of our listeners who haven't come across you and Horizon3 before, let me set the scene a little. So, Sanj started his career at AHL, just nod Sanj if I'm doing this correctly, part of the Man Group. He rose to head of the trading desk, running billions in leverage futures across a 24-hour global operation. He then worked with David Beach at Beach Capital before co-founding Horizon3, originally called Beach Horizon, with Dr. Paul Netherwood. I've met Paul before, and say good day to Paul for me, Sanj. So they've been both running money for over 20 years now, and their approach is genuinely unique in the industry. It combines digital signal processing with a proprietary pattern recognition technology. that nobody else has, and it's a fascinating story. So let's get into it. So, Sanj, can you give our listeners a quick overview of your journey from physics to AHL to where you are today running Horizon 3?
All right. Okay. You want to go back to physics? Okay. So I did a degree. My first degree is physics, and then I ended up doing a master's in finance. And as part of that master's, we did a lot of econometrics, and I kind of did sort of co-integration based sort of paper on FX spot rates versus forward rates and things like that. And I was interviewing for jobs, and just like every other student, you apply for hundreds of jobs and you don't get any interviews. So what I started to do is send through my dissertation, and it just happened to land in AHL, which was considered like a rocket scientist CTA, and it got their attention. So they called me in for an interview, right? Because unbeknownst to me, their whole office was, I mean, Adam, Michael Adam, Martin Lewick, David Harding, super intelligent people surrounded themselves by young, very bright PhDs. You couldn't move for bumping into PhDs in the office. So they loved all of that quantitative research and this, that, and the other. And then that basically got me my opportunity to get into the company, and I was learning to code in their own in-house 4GL, which actually Paul was on the software team actually developing that language. So they had their own, back there in the early 90s, they were so high tech. They created their own language to manage time series data and do research with time series data and manipulate it and create models with it and what have you. So they realized there was nothing out there. So they literally created it in-house to be able to do the kind of model building and research that they did. That's kind of like how high-tech they were. The rest of the building, the Man Group, 150-year-old futures commission merchant, we had this tiny little office on the 5th floor, and down the corridor was like nuts and molasses, ED&F Man Cocoa. The Man Sugar department were responsible for 50% or more of the group's profits, and that's because we shared the building with Tate and Lyle. Right? It was a really old commodity, but the Man had obviously gone into taking stakes in fund managers, so they did that with AHL. And they'd already done it with the Mint Fund and Larry Height Co. and stuff. I dropped these names in a conversation the other day with Paul when I was talking to a young client who's like a millennial, and afterwards Paul goes, "You do realise that guy hasn't got a clue who you're talking about, right?" That's how old we are now, right? Anyway, I went, yeah, right, okay, but I know you guys know who they are, so I'm bringing them up, But yeah, no, so AHL was such an amazing place to work because everyone's so young, so bright, it was so high tech. And we had a lot of fun as well because we were all in the pub after work every night, and we'd go away on like company trips where we'd just go, I don't know, racing around the countryside in hire cars, doing treasure hunts, basically annoying people and stuff. And so it was just I used to come home and tell my friends about, oh, look, we're going to go do this and we're going to do that. And they're like in their boring, mundane jobs, right? And I'm going away for the weekend to do, I don't know, some kind of murder mystery thing or whatever, with the company. So that was all great. And it was so successful. It just grew and grew and grew and grew. When I joined, it was 200 million. By the time I left running the trading desk, we were literally running $10 billion worth of a lot of AHL's assets, but also the Mint Fund and Heitco and other CTAs were putting their execution through our desks, which meant that I was literally trading every futures market in the world, but not just every. I used to have like 3 or 4 brokers in every futures market around the world because I needed the access to the pit, right, from different angles just to get the execution done because the size was so large. So it was a very fun, very exciting time. Learned a lot. Then I moved on to work with David Beach, who, as far as I'm concerned, is the greatest trader that no one's ever written a book about. His pattern recognition methodology that he developed in the early days at Sabre Fund Management, where David Harding also worked, is completely unique. But the way that David traded, oh my God, he had a photographic memory for charts. We would just sitting on the trading desk every day in the afternoon, right? And he'd be doing a run through of what the current state of play is with all the positions in the markets, because we'd have stops at different points in patterns and this and that. And then he suddenly run off over to his filing cabinet, where he had hand-drawn, literally binders and binders full of charts. And he'd go, look, see, same pattern 5 years ago in September soybeans. Look at it, exactly the same, right? And he had a photographic memory for this, not just on daily charts, even on 120-minute charts and things like. He had and he would go out all day. He'd have like a rough map of where all our positions were and what amounts at what stops, and he'd be out and about, and we'd be phoning him, 6 of us on train desk, going, Dave, we've been filled here, and he'd be right, adjust this, add this to that, blah blah blah, this and that, and he'd have it all in his head. And we'd go through a whole volatile trading day of doing that with David on the phone while he's out. And he'd still know exactly by the end of the day what positions were where, what stops were where, what patterns, how the markets had moved in relation to his patterns and everything else. The guy was amazing. I am not kidding. So I learned so much from David. It's not true. But what then happened, right, is we realized that a lot of normal CTA investors were approaching David because they believed him to be a good diversifier against other normal managed model driven programs. So I then realized there's an opportunity for us to create a model driven program in-house with David, which would be complementary to his style as well. And so I wrote some research papers and this, that, and the other, and they agreed it. So I called the best programmer in the world that I knew, Dr. Paul Netherwood, and he came and joined me, and that was the start of us building Beach Horizon as a CTA, and we just launched it as a separate company with David as our senior partner. And that's my journey in a nutshell. I kind of summarized it as quickly as possible.
Your digital signal processing, which is a hallmark of what you were doing there, that was specifically to make you unique in the industry and offer these diversifying returns. Was that your objective?
Well, yes, in a way, that's kind of always one of your objectives, because every client always came into your office, and if they were institutional, they'd be like, don't worry about everything else, just tell us how you're different to everyone else, right? So it was like a real focus on people that invested in bunches of CTAs. They're looking for difference. We weren't necessarily trying to engineer difference. We just looked at the problem of filtering trends from markets, and to us, it's not necessarily obvious, but the engineering mathematics of digital signal processing, especially with Paul's background in machine vision and things like that, it just lent itself to an analysis of markets, so that you're not just, hey, here's a model, here's a system, here's a backtest. It was more of a theoretical underpinning of understanding why we're employing the tools that we're using, and about expanding our actual knowledge of the subject in a scientific way that actually had some credence. So we weren't just going, all right, well, we did a backtest and it seems to be okay, right? We wanted to understand why we were using the filters that we were using, and how you analyze their performance, and what attributes you could learn from analyzing them using digital signal processing that it would give you greater insight into creating a better trend following model. That's what it was all about, kind of thing, from that perspective. And then in terms of the pattern recognition, well, it took us 6 years to automate David's pattern recognition model. Not that it wasn't clearly or mathematically defined, it's just that it was a really difficult problem to solve, right? Even for our massively competent geeks. David already had a team of techies trying to do it for years, and they'd failed. So we took it on, and it took about 6 years to get it done. And while we were developing it and getting it done, we learned more about it. And what we realized is that when we mentioned style filters that are filtering trends from markets are very linear, right? Their relationship with the data is very linear, but actually capturing patterns in markets is very non-linear. So suddenly we thought, hey, That's theoretically quite comforting. We know that the markets do exhibit non-linear behavior and abrupt, sell-offs and things like that the linear systems don't cope well with, right? The kind of vol weighting we were talking about earlier and things like that. So we suddenly realized we were now squeezing more juice out of the same price data that we were not necessarily utilizing that info because the linear models were throwing it away. So that was kind of the theoretical underpinnings of the DSP pattern recognition approach. But at the end of the day,
for a naive listener, can you just explain DSP and the pattern recognition function? So they've got in their mind you're a trend follower. Now what they want to do, the listener wants to resolve, okay, so how does this DSP fit into that trend following landscape?
You are trying to analyze the price's behavior in the frequency domain, right? So and it's not about sort of saying, hey, the prices have some kind of dominant frequency and that's the one you should be capturing, right? Actually, prices, when you analyze them in sort of frequency terms, they're exhibiting all over a certain time period, you'll see all frequencies almost equally represented, right? It was about selecting, right, frequency periods which essentially are like, in a way, you're looking like different lookbacks, right? Different time frames of system, right? But it was about understanding, right, that when you do select different sort of frequency levels, right, in terms of faster systems versus slower systems, are they actually truly diversified? And what we discovered, that actually they were a lot less diversified through the frequency analysis than you'd expect. You'd think, because there was a lot of overlap depending on sort of normal filters, like people using moving averages and things like that. Those filters have a lot of false signals, and those false signals create kind of a dome of overlap where you're not actually getting diversification. You're getting like a more of a centralized net frequency, even though you think you're running all these different models and they're all dispersed and diverse. And we were able to see that through the frequency analysis. So we designed our filters so that they were more diversified. But at the end of the day, you're really just talking about signaling here, right? You can build the best mousetrap in the world if you think you have, but if you haven't got your portfolio construction right or right for the regime that you're in, and you're not capturing these outlier moves and these trends because you aren't in the right markets or you haven't got the right weighting, the best mousetrap in the world isn't going to help you. It's only part of the problem. Do you see what I mean? So that's what you do as a CTA. You try to work on, improving every part of your process because it all works together in the end, right?
So your focus was really the identification of unique correlated streams as opposed to blended, related, causally connected return streams. You were looking at digital signal processing to strictly identify different causal drivers effectively.
Exactly. And then the thing with the pattern recognition was, right, is that if you we all know what a head and shoulders looks like, right? A classic trend reversal pattern, right? But you can have a head and shoulders that takes weeks and weeks to form, or you could have a head and shoulders that forms a significant major market top, like the top of crude at $147, which wasn't a head and shoulders, but it was one of our reversal patterns, which is actually a very, very small pattern. And this is what I'm saying: the features in the data aren't necessarily sort of either frequency related or kind of have a direct linear relationship with the data. You could have a small pattern that forms the top of a multi-year trend, or you could have a very short trend followed by a really big pattern. And and that's why the nature of cracking the pattern recognition problem was difficult, because you had to develop a framework that computers could see visually. Our brains can interpret that very easily.
How hard it is to program something that's visually, I can get it immediately.
That's right.
Oh, and it's the simplest things that are the hardest
Yeah.
to do. Like, where is
That's
the top
right.
of the trend? You know?
It was,
God. Yeah.
it was very. So we had David Beach, his 20 years worth of knowledge and trading and research and photographic memory. And even then, right? It was still a really, really difficult nut to crack. But when we did, we were really pleased because it was theoretically very pleasing. Like I said, it was like, because the digital filters were essentially smoothing the price data and throwing away that more detailed turning point information because they didn't care about it. And it was like we were picking it back up off the floor or taking it out of the bin and saying, hey, no, actually, this information based on the pattern recognition model, that actually has explanatory power. Do you see what I mean? And you're not trying to squeeze like the same data for more juice. You're actually using the same price data, but different parts of the price data to generate your signals. And the two things did work well together. It's a good, it gave us a more of a trader like response, like a bit like Jerry was talking about earlier with the stops and what have you. When we had an abrupt market turnaround where a pattern was formed, what we would do is we would use that to cut our position, and only when both systems agreed again on the short side, or maybe the pattern would fail and the market would trend again, and we'd get back in basis to stop. So we used it as risk management on the core linear trend follower, but it gave us a more trader-like response to these things.
It's definitely an exotic area of trend. That you're not unique in that area, Sanj, because we've got Adrice with his fractal wave algorithm. We've got very successfully deployed. You've obviously done, some great things with your digital signal process. But look, what I want to do is I really want to get onto this FX swap arb trading strategy, which is your new program. Totally different direction here. So, Sanj, can you step us through? I know it's covered in secrecy, but whatever you can you relay to the audience what it's about?
I'm going to be pretty open with you, Rich, because I love you. Right? So I'm gonna be nice to you and give you a lot of knowledge with this, but. Do you want me to kind of just go in and explain what it is and just get into it kind of thing?
Look, if you wanted to explain the mechanics, I'd love you for that, because it's fantastic. It's a structural arb, which I want you to explain to people. It's not a gimmicky thing. It's structural. I want you to explain that. So please, at your liberty and discretion, tell us what you want to release.
Right. So it's actually, right, extremely simple and easy to understand, right? Even for the layman, right? And it's the simplicity of it which scares us a bit, because potentially people will try and replicate it, but there are some complex nuances that are very important that if you don't know, you're not just going to guess them. Do you know what I mean? But I will still explain it to you. So very simply, when you trade into, right, an FX position with a broker, right, if you don't close that position, you want to hold it overnight. So you're in some currency pair. You're either long or short, right? Now, depending on which way round you are in the currency pair, the broker will either pay you or charge you what's called the overnight swap rate, right? So what we do, very simply, right, is we pre-identify, even pre-negotiate. In fact, sometimes our liquidity providers even come to us, right, with offers, right, and I'll tell you why in a bit. But when we've for various currency pairs, we can identify a price difference on the swap rates between brokers on the long and the short side of the trades in various currency pairs. Okay. Now, when we've done that and identified enough of a price difference where we can lock in a profit, right, we go on, and I'm not going to explain exactly how we do this, but we go on and we put on a trade with each broker, right? But essentially, all you need to understand is that we're fully hedged. So we're long with one broker in a currency pair, and we're short with another broker in the same currency pair. And then what we do, right, is nothing at all, right? Because the longer we can hold that position, right? Because now we're market neutral, right? We're 100% hedged, so we're market neutral. So we don't care if the currency goes up or down. But the more days we can hold that position for, right, the more interest rate difference we collect between the brokers, and that activity, right, has generated an average monthly return of over 2% at very low leverage. By the way, and not only that, we've had no losses, no losing months, no losing trades.
I've seen that since 2024. I've seen that as well. So
but it's actually been run, right, for longer than that. In that it's got over a 3-year track, but I don't show that one because we are only offering to clients 100% swap arb program, whereas the 3+ year track has been run more as a blend with 70% swap arb and 30% discretionary trading, directional trading. So I don't like to show that because that's not what we offer clients. I want, and that also has the occasional very small down month, and I don't want that. I want clients to see the no losses going forward into perpetuity, right? So I show a real track, but it's a slightly shorter one that we have for the 100% swap arb program. And yeah, I mean, look, it literally is that simple. I can ramble on unless you want to ask me questions. I can pre-answer your questions for you if you like.
So to get it straight, you've got a perfectly neutral position, totally neutral. Totally matched. Then what you're doing is you're looking for swap differentials, beneficial swap differentials, which you're exploiting and adding to the tin, effectively. Taking no losses along the way. You're perfectly matched. So, question I'd ask: is there risk in the strategy? Where is the risk in the strategy?
Right. Okay. So the thing is, obviously, we're trading with these brokers, so we have counterparty risk, but a lot of fund strategies have counterparty risk. What we don't come with is the more substantive market and strategy risk that other strategies have, right? That's very, very low for us. So yes, there's counterparty risk, but obviously we diversify our positions and counterparties. But because I get asked about this a lot, right? But what I would say to that as well is that because of the nature of what we're doing, we have extra robustness and resilience to counterparty risk than you'd normally expect. Because let's just say, right, we have a problem with one of our counterparties, and that forces us to close a position, our hedge side of the position. And we have to take a bit of a hit, right? And we'd say we lose 3 or 4% on that, right? And we normally don't do that kind of thing. Well, this is not a strategy problem. Most strategies get into problems because it's the strategy that's underperforming. This is like an external problem. We've still got all of our other, many counterparties to carry on trading our strategy with. And because of the nature of our strategy, we are more likely to make back that loss very quickly with more certainty than you would have with 99% of other fund managers. So on that basis, we're exhibiting a lot of resilience and robustness in our process. And let's just say our trade opportunity, I'll explain why this is never going to happen, but let's just say our trade opportunity doesn't exist, and that's our risk as well, right? Well, unlike other strategies, we won't have any trades to do, so we won't actually have.
So worst case scenario.
No, but I'm just saying. Let's say the swap differentials disappeared and we couldn't put our trade on. Well, if we can't put a trade on, the client money isn't at risk. So we might not be making money, but we wouldn't be losing money either. Do you see what I mean? So that's never going to happen, by the way, because the thing about it is, I get asked a lot, and this tell you why. I'm going to explain why that's not going to happen and why this trade even opportunity exists. So I get asked a lot, are we arbitraging an inefficiency, right? Because obviously people who understand ARB strategies, they want to know if the ARB can be, if it can be ARBed away, right? The opportunity can be ARBed away. But I always respond to them, right? And what I say to them is, no, we're actually arbitraging an efficiency, not an inefficiency. Because the thing about it is, right, when you get these brokers' books get skewed, right? And through their normal currency movement and people trading with them. So we're going to them saying
swaps.
Yeah, so we're going to them and saying, hey, look, right, we're going to go against your book, but we want a better swap rate. Sometimes they just come to us, right? And we don't mind going against their book because we're 100% hedging our strategy anyway, right? Our position anyway. So for that, they will do better deals for us in terms of our relationships and our liquidity and stuff. So we're able to embellish the normal swap rate differences between brokers through that mechanism. But essentially, we're helping them lay off risk, just like bookmakers. And it's cheaper and way less hassle for them, right, to give us a better swap rate than actually put on and manage a hedge themselves, right? And run the risk of managing a hedge. So that's why this doesn't go away, this opportunity, because it's the normal operation of the way these brokers work, who are responsible for 30 to 40% of daily FX turnover, by the way.
It's part of a decentralized system that FX is. If it was centralized, you'd lose it, but it's never going to be decentralized, the FX market.
No, so we're kind of doing them a favor, so we're not toxic to them. So, that's why the opportunity exists. But you've got to know exactly how to do it, otherwise you would never make anything like what we do.
Well, it's exceptionally impressive what I'm seeing happen. Look, a couple of quick questions before I pass it over to Adam, because I know he's itching to ask a few questions, maybe Jerry too. Do you need to leverage those returns to get such great monthly results?
We're currently running at about 10 times. This is which is nothing, right? CTAs run at 25 to 30, right? And this, so we don't need to take lots of leverage to make the returns, kind of thing, So there's many positive attributes to this strategy, but the beauty for me, my favorite positive attribute of this strategy is there's no timing risk. Right? A client doesn't have to worry about whether there's a good time or a bad time to get into our strategy. Whenever they invest, they make money from day one. All the clients we've onboarded have made money from day one. And when they want to top up, they don't have to worry about when is a good time or bad time to do it. And that, after being a volatile CTA for many years, with clients, always investing at the highs and suffering the drawdowns and stuff, that's a dream come true for me. I love it. Do you know what I mean?
A favour for me, Sanj? Like, I've seen your equity curves, but can you email Jerry and Adam your equity curves? I know you keep it very confidential and close to your chest, and on penalty of death, does it ever get released? But I'd love them to see.
Yeah, sure. I thought you would have.
I've kept the information under. This is not to be shared amongst everyone. I'm a bit scared about that, Sanj. But if Jerry wants a definition of a smooth equity curve, please shoot him it. But so, Sanj, next question for you is, with such a great strategy like you've got there with that program, has it taken your eye off DSP, or do you find that this strategy now offers complementary diversification benefits to the wider DSP program? What's your thoughts there?
Are we getting to kind of like, are we getting to sort of my general views on where we are with our CTA philosophy and that kind of thing? Is that what you're talking about?
Well, I don't want to lose Horizon3 to arbitrage. I want it to stay a trend follower because we love you as a trend follower, and we don't want to see that disappear because you've found this wonderful arbitrage opportunity. So, what's going to happen there?
When you're trying to sort of navigate different regimes over time, right? in terms of the CTA space, and it's easier to see in hindsight when you're looking back at the entire history of your experience to have a better understanding. Whereas at the time, you kind of can't see the wood for the trees for various reasons, right? One, because of what the market's doing or business pressures or whatever. And you're there hammer and tongs thinking, right, I need to improve signaling. I need to improve portfolio theory. I need to improve all these different things. And some of the things that you try, though, as well, is to diversify, find other strategies to diversify against your directional strategy, whether that be rel-val or whether it be like a mean reversion approach, or, you know, something else. So now we do have something else to diversify against our CTA. So we have, against our directional CTA, we have literally a non-directional strategy. And the way that they can be utilized together is that, well, CTAs have a lot of unencumbered cash because it's a low margin utilization, even if you're volatile, right? So all of the unencumbered cash can be invested into the swap arbitrage program, almost like a cash management program. So all of a sudden then, right, you've now got a 20 to 30% a year, depending on how much cash you put into it, a sort of drawdown cushion, right, that's going to deliver with a level of certainty that you don't get anywhere else, under your CTA. So if you then harmonize the vol of your CTA and you control the vol and harmonize that with the returns you're achieving on the strategy, you've then suddenly made a massive research gain, which doesn't come with a probability. It comes with like a level of certainty that you've never had before, because all other research gains that you may have made in the past always come with some kind of probability associated with them because they're based on history. And so you don't know if they're actually going to work in the future and deliver the extra 2 or 3% a year you think they're going to deliver, right? Whereas here you get to add something, right, that diversifies your model with a level of certainty that you don't normally get.
Thanks, Sanj. Okay, Adam, any questions for Sanj?
Oh, I think you had the good one there on leverage, and then if you're employing leverage, do you have to restrict your counterparty exposure, and how do you manage that?
The thing is that yes, we have a certain cap where we won't go beyond like 30 times leverage, and the reason for that is this. Think about our positions, right? On one side you're long, on the other side you're short, right? So even though we are market neutral, but the market itself is actually moving, right? We don't care about that movement, but on one side you're losing money, and the other side you're making money. So at some point you need to move margin from the winning side to the losing side, and potentially over time, because of the length of time we can actually hold these positions, sometimes over a year, then you might even have to end up moving it back again. So we've set up something that's extremely efficient in terms of dealing with margin movement, which is one of the edges in our strategy and our approach that actually helps us improve the returns.
Okay, and is this done via ISDA?
No, it's not. But the thing is, yeah, if we over leveraged, we'd have to move margin a lot more frequently because we'd have less of a buffer for the margin. Do you see what I mean? So we don't need to do that to generate the returns. You know, I don't think this is going to happen, but even if in the future limiting or capping our leverage meant that we weren't making 2% a month, we'd still be making positive gains every single month. So it'd still be good.
And did you say that the margin moves on the basis of the move in the underlying spot market, or just the carry, the interest paid?
Yeah, it's basis the spot.
Okay. So one party's long a currency pair and the other party is short the currency pair. You're not clearing the market in the interest rate differential between the two?
Well, swap rates are a function of the interest rate differentials between the two countries involved in the currency pair, but they're not exactly that because they're adjusted for by FX brokers, kind of thing. So yes, the swap rate differentials we're getting are not in terms of the basis or the forward the forward positioning of the currency pair you're in. We're actually arbing the difference between the two brokers themselves.
Jerry, do you have anything to say? It's certainly out of our typical trend following speak here, but do you have anything you want to ask?
Well, I'm not understanding it completely, but it is fascinating. I love the 2% per month. I guess it does remind me a little bit of a trade that Moritz talked about over a few years ago, which was arbitraging the futures versus cash Bitcoin. And I think it just went away. There was no way to lose because of the inefficiency, but it kind of just went away when too many people were doing it. Could this strategy possibly suffer from too many people copying your strategy?
Not really, because the thing is, right, our opportunity is limited really by the number of regulated liquidity providers we can execute this strategy with. That's what limits us, not the number of opportunities. There are opportunities occurring literally all the time, every day, every week, that we just ignore. We're not one of these programs looking to capture every arbitrage opportunity. And once our capital's deployed, we ignore new opportunities until such time as we have to close a position due to changes in swap rates. And then we're looking to redeploy that cash, and then we'll look at the set of opportunities at the time. But there are other people that I'm aware of, not regulated funds like us, more prop trading firms that do this. Their returns aren't as good as ours, but I am aware of one group that have been doing it for over 9 years, right? Even our traders were trading this strategy before they launched their fund, and that then had the 3+ year track record. So it's been around a lot longer than just what I'm showing, kind of thing. So I don't think it can be I don't think it lends itself to being arbitraged away just because too many people get into it, because they're not trading with the same people we are. They're not doing it in exactly the same way we are either. They're not even maybe trading the same opportunities we are, because we're not looking to trade every opportunity in the market. So there's a lot of room, I think, at the moment. I'm very excited about what we're going to do with our CTA going forward. Now that it's diversified with this strategy, and it's got a 25% return cushion underneath it. It means that, I could go through periods of flat performance, but I'm very unlikely to enter any kind of heavy period of drawdown because of, we've lowered the overall vol.
Well, look, Sanj, we've got to move on. I was going to ask you about your macro views, because if anyone knows Sanj, and if they've followed you on LinkedIn, they certainly know how active you are in your macro views. And but look, we might move on to the shell mail and finish the spotlight segment. So Sanj, thanks very much for answering all of these difficult questions. Let's move on to the questions brought to us by Lee. So there are a couple of good questions here, and I did promise Lee would get to them on this episode. So here's the first question. So Lee says, if I'm a US retail trader running 2 systems, and system 1 is long 3 gold contracts, while system 2 wants to go short 1 gold contract, the problem is in the US, my account just nets it to 2 long. I can't hold both a long and short on the same contract at the same time. What should I do? So, look, just to give viewers what this means. So in the US, there's a rule called FIFO, first in, first out. And what it means is that your broker will not let you hold a long and short position on the same contract in the same account at the same time. So if you're long 3 February gold contracts and another system wants to short 1 February gold contract, the broker doesn't create a separate short, just reduces your long from 3 to 2, and you end up with this net position. So, look, to be clear, it doesn't matter or when the signals are generated. For instance, I might get a long position now, and then 2 weeks later, I might get a short position. The net's going to occur when I get that short position. So it's not just relating to contracts taken on the same day. This FIFO applies across time as well. So, look, gents, have you got any advice for Lee?
Well, this is an easy one. You need to, because this happens with us as well. And so what you need to do is just not use your broker statement as you got to create an Excel spreadsheet that keeps track of each system and then each system's positions, and then subtract those two out and come up with a net position. Sometimes the net will be different than because you'll be long and short in 2 different systems. So just got to use an Excel spreadsheet or some sort of software that handles this administrative issue for you.
Sanj, anything to add? I think Jerry's covered it.
Yeah, no, I mean, Jerry's exactly right. You have to separate the kind of the position creation of your models, and then when it comes to execution, you have to net out what the net position requirement between the models are, and then look at what your position was before and see what your new position requirement is, and just do the net trade. When I was reading the question, I was kind of looking at it thinking, Lee might think that for some reason he needs to have 2 positions, but actually that's irrelevant, because whether you've got 2 positions, if you were allowed to have 2 positions, or whether you've got one netted off position, the net benefit from the same market to you is exactly the same. So it's much more efficient to have a net position, obviously.
So here's the next question, and this is a good question from Lee, and it's a great issue to have, I've got to say. So he says, I'm a US investor, but because of the global diversification and the emerging markets outperforming with his strategies, he's obviously very diversified with different currencies. I've built up balances in all sorts of currencies: Hong Kong dollars, Korean won, Swedish krona, Malaysian ringgit. What do I do with them? Do I hedge them, write an algo to convert them back to US dollars and at the right time, or just spend them as I travel? So, look, we've got to be aware for Lee's perspective. He is a traveller. He travels the world.
He's living the dream. He's living the trend-following dream.
And I don't think he has any plan on settling in any place too long. So it's probably a great thing to have. He's got these separate bank balances all across the world. It's a lifestyle decision. Probably keep it whatever it is. But Jerry, to you first. Is there a solution for Lee?
Well, we have the same issue and have for many, many years. And so when the balances become non-trivial, we convert them to our base currency. So monthly, or when they get to a certain level, converting them and keeping that at 0 all the time is going to be costly, because you may do another trade in that currency. So I just think making those balances kind of a trivial or non-material level, don't think about them until they are not immaterial. Then you can go ahead and put them back into your base currency.
Perfect.
I like the idea of traveling the world and having those currencies. I get in countries sometimes where I can't find an ATM. I don't think I've ever found an ATM in Stockholm. So it was always an issue. I had euros and dollars, and my wife doesn't like for me to use those when I'm in another country that has their own currency. Just worried about that.
Adam, any thoughts?
So from our perspective, we bring foreign currency exposure home at the end of every month. Probably somewhat similar to what Jerry does. And but I had an out-of-the-box solution to Lee's problem, and that is, if you got a whole lot of currency then you should just go and live there for a while and spend that money.
I like that.
So don't bring it back to the US dollar. If you make a whole lot of Korean won, well, you should go to Seoul and just hang out there. And then if you made a whole lot of Malaysian ringgit, well, you should just go to Malaysia, go to KL and spend the money there, and so on and so forth. And then you're just basically going wherever your portfolio is making money. But that's my out of the box.
Following your profits.
But yeah, you're following your profits. That's my out of the box solution. If you want an institutional answer, you just bring it home at the end of every month.
I love that. And I think it has some karma to it as well.
Yeah.
I love that. Yeah.
It'll be exciting.
Yeah.
So, Lee, I hope that wraps everything up for you, mate. And it was great seeing you, and we hope to see you more regularly as well. So, let's close up this podcast. It's been a long one. I've got some substantial editing to do. However, it's been a great show. And Sanj, thanks so much for participating in this one. But look, what I would like is if you could let our listeners know how to get in contact with you about Horizon 3, your swap arb strategy, etc. How do they find you?
Yeah, they can just go to our website, which is www.h3im.com, and make an inquiry that way. They can always email me, sanj@h3im.com. But, generally we only look for institutional, professional, qualified clients kind of thing. Not too much, we don't look to sell our fund in the United States because we're not regulated to do that. But it's not usually efficient for tax purposes for US investors unless they have like the Reg D exemption and things like that, right? So we don't market to retail, but yeah, it's easy enough to get hold of us via our website, and we're more than happy to engage. So thank you very much, and if you guys want to give us your cash, we'll take that too.
Oh, we all like that cash. So before I go, though, I want to take a moment to talk about something very close to my heart. It's called The Fractals of Finance, which I've written and is now available on Amazon in Kindle, paperback, and hardcover. So I want to share quickly why I wrote this book, because I think it's going to resonate with a lot of our listeners. So my journey into trend following didn't begin with insight. I began with loss, effectively. So since about 1985, I've searched for certainty in markets. I trade fundamentals, I tried options, I tried pairs trading, I did a bit of arbitrage, not like Sanj is doing, but every model I could build, I was looking at. So each one promised control, each one delivered brief triumphs followed by ultimate disappointment. But what they all lacked was endurance. So after years of searching, I found this small group of traders who had survived through crisis and cycles while others disappeared. And they were the trend followers, who we all are here. Their methods were simple. The discipline was absolute. The longevity could not be denied. But even among them, I sensed there was something missing. They could describe what they did, but not the principles and how they worked. They knew the rules, but not the deeper structure underneath. So that's what this book is about. It's about the geometry beneath the markets. It explores why extreme events are far more common than we're taught to believe, why the once-in-a-100-year event keeps happening every few years, and why traditional models, the ones built on normal distributions, efficient market assumptions, consistently fail. So more importantly, it shows why classic trend following is uniquely positioned to navigate this reality. So when you understand the nature of market distributions, the fat tails, the clustering of volatility, the self-similar patterns across time frames, you understand why systematic trend following isn't just a strategy, it's a survival mechanism. So whether you're an experienced trader or just starting to explore systematic approaches, I believe this book is going to change the way you think about markets. So do yourself a favor, if you can, get your hands on a copy of that book. So that's a wrap for episode 11 of Turtle Talk. If you enjoyed today's show, please leave us a review, share it with a friend, and don't forget to subscribe so you never miss an episode. And from all of us here, stay systematic, stay patient, and may the trend be with you. See you next time.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own, and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time, and as always, may the trend be with you.